There's two specific tools that we're going to talk about today. The first is called the Buffer ETFs. The name reveals a lot. You're kind of buffered from the full brunt of the market activity. And the other is called Fixed Index Annuities. So that they're two very different products that accomplish similar objectives, but with different trade-offs. So, I mean, this is a super common thing that people are curious about, especially if they've recently been through some sort of event in the market that freaked them out close to retirement. If we had earlier this year, we had a dip in the market that, got a lot of people worried. And if you're close to retirement, you might be thinking, well, should I look at trying to mitigate that risk through some sort of alternative tool? Let's start with Buffer ETFs.
Yeah, let's talk about how they work.
This is very general. We're not going to get into specifics. There are plenty of flavors of these, and they're offered by many different companies. But essentially what you have is it's an exchange-traded fund, and let's say, for example, it's based on the S&P 500. It's tracking that index, so it owns those securities. But it has some kind of hedging strategy in place, usually using options contracts. And the result is that maybe you get to participate in up to 15% in growth. That's sort of your upside cap.
So if you have a really great year in the stock market and returns for the S&P 500 are 15% or less, you get that return.
Yeah, but if it's 20%, you're capped up at 15.
You only get 15.